we choose policy.
Luca Di Leo from Dow Jones. Mr. Chairman, what's the right response if high oil prices persist? On the one hand, they push inflation higher. On the other, they can hurt the economy by hitting spending. In the current environment, what's the best strategy?
Well, we're going to continue to see what happens. Our anticipation is that oil prices will stabilize or tend to come down. If that happens, or if at least oil prices don't increase significantly further, then inflation will come down, and we'll be close to our medium-term objectives. As we look at oil prices, as you point out, we have to look at both sides of the situation. I do think that one of the key things that we'll be looking at will be inflation expectations, because if medium-term inflation expectations remain well anchored and stable, so that firms are not passing on, at least on an ongoing sustained basis, these higher costs into broader prices, into creating a broader inflation in the economy. As long as inflation expectations are well stabilized, that won't happen. Then we'll feel more comfortable just watching and waiting and seeing how things evolve. Again, if we fear that inflation expectations look like they're becoming less anchored, we would have to respond to that.
With Nightly Business Report, you've talked a lot in the past about the problem of long-term unemployment. Can the Fed effectively reduce long-term unemployment?
Well, first, you're absolutely right. Long-term unemployment in the current economy is the worst, really, the worst it's been in the post-war period. Currently, something like 45% of all the unemployed have been unemployed for 6 months or longer. And we know the consequences of that can be very distressing, because people who are out of work for a long time, their skills tend to atrophy. They lose contacts with the labor market, with their other people working, the networks that they've built up. And we saw in the European experience, for example, in the 80s and 90s, that a period of high unemployment with very long-term unemployment spells can actually lead unemployment to remain very high for a protracted period. So it is a very significant concern. And it's one of the reasons that that the Federal Reserve has been so aggressive. By getting unemployment down, we hope to bring back to work some of the people who've been out of work as long as they have, and in that respect try to avoid the longer-term consequences of people being out of work for months at a time. So that's part of the reason that we have been as aggressive as we have. As the situation drags on, and as the long-term unemployed lose skills and lose contact with the labor market, or perhaps just become discouraged and stop looking for work, then it becomes really out of the scope of monetary policy. At that point, job training, education, and other types of interventions would probably be more effective than monetary policy.
We're seeing now, do you think that's out of the scope of what the Fed can do?
Well, indirectly, of course, if to the extent that we can help the economy recover and help job creation proceed, then some of the people who get jobs will be those who've been out of work for a long time. That being said, we don't have any tools for targeting long-term unemployment specifically. We can just try to make the labor market work better, broadly speaking.
Peter Barnes of Fox Business Network, Mr. Chairman. Last week, Standard & Poor's put the United States debt on a negative watch for the very first time ever. What is your reaction to that? And are you concerned, are you worried that the United States is going to lose its AAA credit rating?
Well, in one sense, S&P's action didn't really tell us anything, because everybody who reads the newspaper knows that the United States has a very serious long-term fiscal problem. That being said, I'm hopeful that this event will provide at least one more incentive for Congress and the administration to to address this problem. I think it's the most important economic problem, at least in the longer term, that the United States faces. We currently have a fiscal deficit which is simply not sustainable over the longer term. And if it's not addressed, it will have significant consequences for financial stability, for economic growth, and for our standard of living. It is encouraging that we are seeing efforts on both sides of the aisle to think about this issue from a long-run perspective. It's not a problem that can be solved by making changes only for the next 6 months. It's really a long-run issue. We're still a long way from a solution, obviously, but it is, I think, of the highest importance that our political leaders address this very difficult problem as quickly and as effectively as they can. And to the extent that the S&P action goads a response, I think that's constructive.
Mr. Chairman, John Berry. In the past, there have been times when fiscal policy has tightened and the Federal Reserve has chosen to ease its policy in response partly to that, given whatever the circumstances in the economy were at the time. Congress appears intent at this point in cutting spending significantly, might restrain the economy as it appears to be doing in Britain, where they're following a similar path. Is there anything the Fed can do or should do if indeed there are large budget cuts sometime in the next 18 months?
Well, first, let me say that addressing the fiscal deficit, particularly the long-run unsustainable deficit, is a top priority, and nothing I would want to say should be construed as saying that I think it's anything other than the top priority. It's very, very important that our leaders address this issue. I would also say that the cuts that have been made so far don't seem to us to have had very significant consequences for short-term economic activity. Now, my preference in terms of addressing the long-term deficit is to take a long-term perspective. It's a long-term problem. If Congress and the administration are able to make credible commitments to cutting programs or in any way changing the fiscal profile going forward over a long period of time, that is the most constructive way to address what is in fact a long-run problem. If the changes are focused entirely on the short run, then they might have some consequences for growth, and in that case the Federal Reserve, which is, as always, going to try to set monetary policy to meet our mandate, would take those into account appropriately. But so far I've not seen any fiscal changes that have really changed our near-term outlook.
Thank you, Mr. Chairman. I'm Toshi Ogata with the Asahi Shimbun Japanese newspaper. I'd like to ask about the uncertainties in the global economy or downside risks. In minutes from the March meeting, the committee noted that the development in Japan increased uncertainties. So what's the latest assessment on those risks or uncertainties, such as tragedy in Japan or crisis in Europe and uprising in the Middle East? And what would be the impact of those on the U.S. economy and the world economy?
Well, one of the things that our projections include, we've only producing the forecast today with our minutes in 3 weeks will include the full detailed projections as we normally do. One of the things that we include is the views of the participants on the amount of uncertainty there is in the forecast going forward. And I think I can say without too much fear of giving away the secret that FOMC participants do see quite a bit of uncertainty in the world going forward. And a lot of that uncertainty is coming from global factors. I've already talked about Middle Eastern, North Africa developments which have affected oil prices, conditions in emerging markets which have affected commodity prices and other things. The European situation continues, and we're watching that very carefully. Now, obviously, you asked about Japan. Let me first say, that I've had a lot of contact with my Japanese counterparts Central Bank Governor Shirakawa and other people in the Japanese government. We collaborated with them on the foreign exchange intervention, as you know, and we are very admiring of the courage of the Japanese people in responding to these situations, and of the Central Bank of Japan has done, I think, a good job in providing liquidity and helping to stabilize financial markets in what are very, very significant disturbances to the economy. The implications for Japan have been discussed at some length, and I think Governor Shirakawa recently talked about them. In the near term, there will probably be a decline in Japanese output, reflecting the destruction, reflecting electricity problems, etc. We believe that will be relatively temporary and that the economy will start to come back. But, of course, this is a major blow, and it will take a lot of effort on the part of the Japanese people to restore the economy and to recover from the damage that was done by the tragedy. For the United States, we are looking at this very carefully. Thus far, the main impact of the Japanese situation on the U.S. economy has been through supply chains. We've noted some automobile companies, for example, that have had difficulty getting certain components, which are manufactured mostly or entirely in Japan. And that has led a number of companies to announce that they would restrain production for a time. So there may be some moderate effect on the U.S. economy, but we expect it to be moderate and to be temporary. Again, the most important issue here is the recovery of Japan, and our good wishes go out to the Japanese people and their efforts to overcome the adversity that they're facing.
Mr. Chairman, you have often stressed, as indeed you did again today, the importance of keeping inflation expectations low and stable to keep inflation itself under control. But irrespective of inflationary expectations or psychology, isn't it possible that the Fed's policies could be providing the monetary tender for inflation the longer they continue?
Well, we view our monetary policies as being not that different from ordinary monetary policy. I mean, it's true that we've used some different tools, but those tools are operating through financial conditions, and we have a lot of experience understanding how financial conditions, changes in interest rates, changes in stock prices, and so on, how they affect the economy, including both growth and inflation. So we are monitoring the state of the economy, watching the evolving outlook, and our intention, as is always the case, is to tighten policy at the appropriate time to ensure that inflation remains well controlled, that we meet that part of our mandate, while doing the best we can to ensure also that we have a stable economy and a sustainable recovery in the labor market. So the problem is the same one that central banks always face, which is choosing the appropriate path of tightening at the appropriate stage of the recovery. It's difficult to get it exactly right, but we have a lot of experience in terms of what are the considerations and the economics that underlie those decisions. So we anticipate that we will tighten it at the right time, and that we will thereby allow the recovery to continue and allow the economy to return to a more normal configuration, at the same time keeping inflation low and stable.
Hugo Noré with Agence France Presse. Many of the commercial partners of the United States are very concerned about the evolution of your foreign exchange rate. If in one hypothetical case the dollar would sink to a not tolerable level, which would harm very much the U.S. economy and the prospect for the global economy because it affects the confidence of so many people, would you consider changing your monetary policy in accordance to that threat?
Well, as I said earlier, we do believe that a strong and stable dollar is in the interest of the United States and is in the interest of the global economy. our view is that the best thing we can do for the dollar is first to keep the purchasing power of the dollar